Year 2023 had high and lows for everyone. Some of them being housing market, student loans. Cost of buying a house was high due to Feds rising the interest rate, making mortgage expensive. People held on to their money due to looming recession scare in 2023. There was a lot of disappointment going on. But all that is behind as we step into new year. Let's look into 8 things that you need to do differently in 2024. 1. Get on the same page with your spouse. Many couples fight over money. It's no secret that money is one of the leading causes of divorce. Getting on the same page with your spouse about money is crucial for a healthy and successful relationship. It is also important for growing your family's wealth. I would encourage you, if you haven't already with your spouse, get on the same page, have a goal that you're working towards together. See yourselves as one team, because that's a key part of winning financially and it helps your marriage. Here are some tips to help you achieve financial alignment with your spouse. 1. Open communication. Schedule regular money talks to discuss your financial goals, concerns, and priorities. 2. Set common goals. Establish short-term and long-term financial goals together. This could include saving for a vacation, buying a home, or planning for retirement. 3. Understand each other's money personality. People often have different attitudes and behaviors toward money. Understand each other's money personalities, whether one is a spender and the other is a saver, and find ways to compromise. 4. Designate responsibilities. Clearly define financial responsibilities and roles within the relationship. This includes bill payments, budget tracking, and long-term financial planning. 2. Get on a budget. No one accidentally is successful at business, no one accidentally has a successful marriage, and no one accidentally builds wealth. It doesn't happen, it's with a plan, and the plan on a monthly, weekly basis is called a budget. Write it down, get on there with your spouse, be in agreement, and when you're aligned on that, you will be able to manage money well. John Maxwell says a budget is people telling their money what to do instead of wondering where went. Here are major steps that will help you get on a budget. 1. Gather financial information. Collect information about your income, including your salary, bonuses, and any other sources of income. List all your monthly expenses, including rent or mortgage, utilities, groceries, transportation, insurance, debt payments, and discretionary spending. 2. Categorize your expenses. Divide your expenses into fixed and variable categories. Fixed expenses include bills that remain constant each month, like rent or mortgage, insurance, and loan payments. Variable expenses include discretionary spending like entertainment, dining out, and shopping. 3. Calculate your monthly income. Determine your total monthly income by adding up all sources of income. 4. Create your budget. Use a budgeting tool or spreadsheet to organize your income and expenses. You can also use budgeting apps that automatically categorize your spending. Allocate a specific amount to each expense category based on your income and priorities. 5. Prioritize savings. Include savings as a non-negotiable expense. Aim to save a portion of your income, even if it's a small amount. This can be for emergencies, future goals, or retirement. 6. Track your spending. Monitor your spending regularly to ensure you're staying within your budget. Consider using budgeting apps that sync with your bank accounts to track transactions automatically. 7. Adjust as needed. Periodically review your budget to see if it reflects your current financial situation and goals. Make adjustments as needed, especially if there are changes in income or expenses. 3. Pay off your student loans. Over the past year or two, the government led us on a convoluted path with promises and various commitments. However, the time has come to address a specific type of debt that tends to linger: student loans. It's a kind of debt that people often hang on to, almost as if it's a normal part of life. The challenge lies in motivating yourself to eliminate it. This year presents an opportune moment to take charge and create a plan to free yourself from this burden. While it's natural to accumulate various debts, student loans seem to have a unique staying power. Many individuals adopt an apathetic attitude towards them, considering them an accepted part of life. However, it's crucial to find motivation to liberate yourself from student loans. Imagine reclaiming that monthly payment and redirecting it towards your goals. The goal is to eliminate all your debts, and student loans should be no exception. Instead of allowing it to persist as a seemingly unshakable presence, gather the motivation to rid yourself of this financial burden. Once done, you can enjoy the peace of mind that comes with being free from the constraints of student loans. It's time to create a plan, take decisive action, and bid farewell to student loan worries. 4. Protect your emergency fund. People may be tempted to tap into this fund, but let me guide you through its purpose. If it's not an emergency, refrain from using the emergency fund. For instance, buying a couch, getting a base boat, or handling regular expenses like Christmas doesn't qualify as emergencies. Emergencies are unforeseen events, and planning and budgeting can help minimize the likelihood of such situations. The more proactive you are in planning and budgeting, the more financial flexibility you'll have. This proactive approach reduces the chances of declaring something as an emergency. Suppose, for example, your car needs a repair. If you've diligently planned and budgeted for car repairs, you can allocate funds from that category instead of dipping into the emergency fund. It's a practice that requires time and consistency. Remember, the emergency fund serves one purpose and one purpose only: to provide a financial safety net in unexpected situations. It's not an investment, it's insurance for peace of mind. Over time, as you build and maintain the emergency fund, you'll develop a sense of security. When a genuine emergency arises, you might find yourself instinctively seeking alternatives to avoid touching the fund. This fund becomes a source of reassurance, and the longer it stays intact, the more you become inclined to preserve it for true emergencies. 5. Try out a new side hustle and create more margin. Exploring side hustles offers numerous opportunities, and one effective approach is to identify your natural strengths and skills. Consider what you excel at and how you can monetize those abilities. Whether it's tutoring, sports coaching, or leveraging any other innate talents, there are various ways to charge for services that align with your strengths. In today's world, there's a wealth of options for side hustles. Platforms like Uber, grocery delivery services, and numerous gig economy opportunities provide avenues to generate extra income. This additional cash flow can be particularly beneficial during the initial stages of your financial journey, especially when focusing on the financial freedom in 2024. It's about recognizing the potential for diversifying your income streams and strategically capitalizing on available opportunities. 6. Prioritize contentment. When you no longer feel the need to acquire everything suddenly, it transforms your perspective. Perhaps embodying the sentiment that godliness with contentment is great gain, contentment emerges as one of the most potent financial principles. Contentment becomes a guiding force that allows you to steer clear of debt, facilitates debt repayment, creates room for generosity, and provides the space to invest wisely. In contrast, an incessant pursuit of consumption, living within the basket of materialism, stands as the antithesis of contentment. The idea that accumulating possessions will bring happiness is debunked. The notion that acquiring more can outpace discontent is a fallacy. It becomes evident that no amount of earnings can compensate for a perpetual cycle of mindless consumption. The reassurance lies in embracing the understanding that, it's going to be okay, it's just some stuff. This perspective acknowledges that material possessions are not inherently negative, but the belief that they can be the sole source of happiness is misguided. The constant pursuit of more, fueled by societal influences like social media, becomes an exhausting and never-ending race. Instead, finding contentment and declaring, "I'm done, I'm good," carries immense significance. Contentment, in this context, becomes a powerful antidote to the relentless pursuit of materialism in a world saturated with stimuli, offering respite from the constant craving for more. 7. be aware of lifestyle creep. Approximately 25% of the top 10% of tax filers, those with an income of around $175,000 per year, categorize themselves as poor, very poor, or just getting by with tight finances. This revelation often elicits skeptical reactions, as it highlights the intriguing phenomenon of individuals adapting their lifestyles to the edge of their earnings. It's fascinating how people can learn to navigate the boundaries of their income. A notable example was shared by an individual worth around $30 million, who candidly recounted his experiences. He acknowledged the transient happiness derived from material acquisitions, such as buying an extravagant car, only for the satisfaction to diminish rapidly. He emphasized that despite having pursued various indulgences, true contentment was found in simple pleasures like fishing with friends, experiences money couldn't buy. This underscores a universal truth: the pursuit of an ever-increasing income doesn't guarantee lasting happiness. The elusive nature of contentment becomes evident as individuals, regardless of their earnings, tend to adjust their lifestyles to meet their current financial standing. This is particularly evident in the concept of lifestyle creep. Each salary increase is met with an elevated standard of living, perpetuating the cycle. To break free from this cycle, it's crucial to keep lifestyle inflation in check. Living below your means is a powerful strategy, especially when faced with a raise. Rather than succumbing to the temptation to match increased earnings with a higher lifestyle, purposefully allocate the extra income towards financial goals. Recognizing the sneaky nature of lifestyle creep and adopting a deliberate approach to spending are pivotal steps, particularly if you're aiming to make 2024 the year you gain control over your financial trajectory. 8. Buy a house only when you're ready. Calm down. There's often an exaggerated frenzy surrounding home purchases. While I encourage you to consider homeownership as a pivotal element in long-term wealth building, it's crucial to approach it with caution. Improperly buying a home not only hampers your wealth accumulation but also introduces stress into your life, turning what could be a blessing into a potential curse. Let's define the proper approach before delving into what it isn't. Firstly, you must be debt-free before embarking on homeownership. Regardless of your aspirations, being in debt when you buy a house is a recipe for financial complications. Unexpected expenses, like a malfunctioning heating system or a leaky roof, can quickly turn your dream home into a financial burden. If student loans are part of your financial picture, it's advisable to address them first. Sally Mae shouldn't have her own bedroom in your new home. Secondly, having a robust emergency fund in place is non-negotiable. Homeownership, contrary to renting, entails ongoing maintenance costs. Landlords handle these issues in rental properties, but as a homeowner, you're responsible. Without an emergency fund, you risk financial strain when unforeseen repairs arise. When it's finally time to make a purchase, stick to a 15-year mortgage and ensure that your mortgage payment doesn't exceed a quarter of your take-home pay. This ensures that your home is an affordable investment rather than a financial strain. The enormity of the decision to buy a house lies in its potential impact on your financial well-being. There's little room for middle ground. Either it becomes a significant positive influence in your wealth-building journey, or it turns into a substantial financial setback. Therefore, exercise caution, steer clear of the housing market until you're financially prepared, and make informed decisions in 2024 to set yourself up for success.